Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, we'll bring you the latest read on the economy as the Fed's preferred inflation gauge crosses the wire. Then we'll have a little crypto corner. We're going to sit down with the CEO of Strategy following that firm's latest Bitcoin purchase, and we'll go live to the stock exchange for a conversation with BitGo CEO Mike Belshe as that company goes public. Then we'll hone in on the state of the consumer as Procter & Gamble sees U.S. spending weakening. Let's take a check on the major averages right now. We are seeing a rally underway, although it's a relatively modest one, and we're not really seeing any clear leader today in terms of the three major averages. That is, the Dow is up about 240 points, about 0.5%, the S&P 500 up about 1/3, and the NASDAQ up about 0.5% as well. Sort of continuing on to some degree the relief rally from yesterday's sort of bring down intentions from President Trump regarding Greenland. And then also we've got some earnings flow beginning today or re-kicking off today. So taking a look at the sectors within the S&P 500, you've got utilities and industrials lagging, communication services and financials leading. Not a huge narrative there. The NASDAQ 100 showing that there's some relative strength within technology today. Meta shares in particular strong, up by nearly 3%. And then since we're going to be talking a lot about crypto later, just wanted to get a check on what we're seeing there, and not gains in short. So Bitcoin prices are pulling back a little bit today after we'd earlier seen some gains, so back below 90,000 as we continue to see turbulence in that cryptocurrency. Elsewhere, you're not really seeing many gains either. And if you look at the crypto related stocks here, they too are mostly falling. Galaxy leading the declines right now. Bullish also down 2.25%. Speaking of two companies that came public in the last year, and as I mentioned, we're going to speak to another one later in the show. Let's get to that economic data now, because we've got PCE data for November crossing the wire. Let's send it over to Yahoo Finance's Fed correspondent Jennifer Schonberger to break down the Fed's preferred inflation gauge. Jen?
Hey there, Julie. Yep, crossing the wires right now. Personal consumption expenditures index on a core basis, clocking in year over year at 2.8%, month over month, up 0.2%. That is right in line with expectations. Now, recall that this is a number that is delayed because of the government shutdown. And so the Bureau of Economic Analysis also had to do a bit of gymnastics to back into this number because it is combined for October and November. And for portions of October, they had to use the average of September and November figures. So we should probably take this with a little bit of a grain of salt, as we did for other data measures for October and November previously. Having said that, 2.8%, it's closer to 3% than the Fed's 2% inflation goal, and sitting right where it was at the beginning of the fall in September. So this certainly doesn't change the course for the Fed's meeting next Wednesday. And if anything, I think it solidifies it, because you had the unemployment rate drop in December to 4.4%. There's really no reason for the Fed to cut at this point, especially given the 3 rate cuts that they did at the tail end of last year.
Okay, Jen, so no drama on the actual data front today, but there is never-ending drama maybe on the question of who's going to be the next chair of the Federal Reserve. We heard President Trump allude to it in his speech yesterday. Didn't really give any hints except for saying he, which some people have pointed to. I don't think that's a huge surprise. But as you know, you've been covering this very closely. In recent days, it seems like it's not going to be Kevin Hassett, sort of depending on what the president is saying. And I'm looking at the odds on Polymarket. Kevin Warsh is back in the number one position with a 45% chance being priced in.
Yeah, the horse race continues. And, Secretary Bessent said that we could get an announcement from the president post Davos. So this is his last day in Davos today. So, let's keep watching closely. To your point, the president made some comments yesterday on CNBC, essentially saying that he's narrowed it down to really 3, but no, he has the person in mind, of course, not saying who that person is. And like you said, it doesn't seem like Kevin Hassett is in the running anymore because the president basically said last week, I like you where you are right now in your current position. And I think a lot of that has to do with what was going on with the criminal investigation into Chair Powell and the red flag that that raised for many market participants over independence of the central bank and who the president would pick and whether that person would be loyal to the president over the economy. And so for that reason, I think he recognizes that maybe Hassett isn't the best choice. Now, of course, that leaves Kevin Warsh, who is favored by Senate Republicans. And then, of course, there's Rick Rieder from BlackRock and Chris Waller, current governor at the Fed. So I think it remains the horse race between those three at this point. Look, it's difficult to get inside the president's head, so we'll have to see.
You said it. Thanks, Jen. Appreciate it. Well, there are many questions about the future of the Federal Reserve, from leadership to independence, not to mention the path for rates. Joining us now to talk more about that and sort of look at the Davos situation, Tobin Marcus is joining us, Wolfe Research Head of U.S. Policy and Politics. Tobin, I do want to start with the Fed. We just got the PCE data. We just talked to Jen about the president's latest thinking. I thought one of the most interesting things he talked about in the speech that he gave in Davos were not one of the most interesting things about the Fed specifically. He said, the problem is you interview these guys, they say what you want to hear, and then you appoint them to the position and they do what they want. And I don't know what we take away from that in terms of giving us any clues. What did you think?
Yeah, he clearly has expressed this kind of sentiment repeatedly about Powell. He got, advice from his then economic team to pick Powell, and everything went great. And then as soon as he got in there, he started making decisions that the president was not so fond of. And given that that's still his mindset, it makes it a little hard for me to picture Reeder being the pick. Respected guy, but if you're worried about this notion that, just like in the first term, you're going to rely on the endorsement of your senior economic staff to pick this respected person that you don't have a very deep relationship with, and then have to count on them kind of doing what you want them to do, that doesn't paint a very reassuring picture from Trump's perspective, in my mind, for picking Reeder. And for precisely the same reason, I don't think that Hassett is out of the running. I mean, the comment he made about wanting Hassett at NEC rather than the Fed seemed offhanded. It was a little bit of a quip, in my mind, about how much he values him where he is, a statement of appreciation more than like a firm public pronouncement that he's definitely not still in consideration.
Yeah, so it sounds like, though, Warsh also in your mind might still be in the running too?
Yeah, absolutely. I think either Kevin's very easy to imagine, but beyond that said, I do still have a hard time picturing Reeder or Waller for similar reasons. Warsh, the hawkishness remains a little bit of a curiosity in terms of why it is that he's gotten such consideration from the president, but the president sure does seem to like him despite his career-long hawkishness on balance sheet issues in particular. I think that the positions that Warsh has articulated don't really line up with President Trump's goals perfectly in terms of what he wants to see from the Fed, but he's been clearly in consideration the entire time despite that.
Tobin, switching gears, let's talk about what's been occurring in Davos elsewhere. Obviously, we heard the president talk about Greenland as well, but also getting a lot of attention was a speech by Canadian Prime Minister Mark Carney, where he talked about the rupture of the international rules-based order, and he talked about the implications for what he called a middle power like Canada. I'm curious, putting that together with the president's speech, kind of what the implications are and what investors need to pay attention to.
Yeah, I think a lot of countries are looking at the kinds of moves that have been made recently and figuring it seems like we're in a bit of a might makes right world where they can't really rely on predictability based on the old rules that used to apply from the United States. And so I think that clearly was a consideration in Canada striking this deal with China, trying to find alternative export markets if they're not going to be able to rely on the U.S. They don't know how the USMCA negotiations are going to go this year, which is, I think an unfortunate consequence of the policy that we've been pursuing here in the U.S. There's been lots of talk at various points about how really the purpose of a lot of what's being done is to create a united front against China. There's been a lot of talk about a fortress North America where, we get Canada and Mexico to erect shared walls against Chinese investment and imports to make a more deeply sort of interwoven economic zone here in North America. And this, of course, is not that. So, from an investment perspective, I don't, a lot of the geopolitical stuff, as always, is sort of noise that's going on that markets, like to look through when they can. We, of course, saw a big sell-off on Tuesday on the Greenland news, but we're largely reversed that now that we've sort of ruled out the really, really bad downside consequences. But, the main event from a U.S.-Canada perspective will be the USMCA renegotiation with what's understood to be a deadline this year, although it's not a particularly binding deadline. And if something goes sideways, then the auto industry, most of all, I think, has exposure to potential risks there. But we do think that that'll get extended in some form.
I mean, last year, to some extent, was a story of diminishing impacts on the market from Trump risks, right? Sort of from Liberation Day on forward. And this year, it felt like we sort of forgot for a second, and then we were reminded. But do you think it'll be a similar pattern where you get these sort of little shocks, but there's maybe diminishing market impact as the year goes on?
Yeah, I think that's probably right. But, honestly, even more so in some of the single name shocks than in the kind of big picture macro geopolitical shocks, we are still seeing people not looking through this in terms of actual pricing. So the 10% credit card rate cap that President Trump announced, he'd initially said he was doing it unilaterally. He said banks were going to be in violation of an unspecified law if they were not in compliance by January 20th. We're now past January 20th. Nothing has happened. And in his Davos remarks yesterday, he called on Congress to take action there, basically admitting that he can't do it himself. And yet, some of the companies with the most obvious exposure to that, companies like Capital One, are still substantially off. They have not rebounded fully from the sell-off that we saw on that news in the first place. So it's possible that that needs to be sort of relearned in new contexts by market participants, that we sort of saw what the tariff, taco playbook looks like. People need to get their head around what the playbook looks like on some of these more sector-specific and company-specific threats.
Tobin, as somebody who tracks DC so closely, is there any chance that the president will get buy-in from Congress and be able to pass a credit card cap or the ban on institutions buying single-family homes, for example?
Yeah, the credit card rate cap, I think, is essentially 0% chance. That is not happening. There's been a lot of very, very overt skepticism about that from Republicans in Congress. And it's, the concerns about unintended consequences are very real. It would genuinely be a very bad outcome if they did that in terms of consumer access to credit. Some of the other things he's called for, the restrictions on institutional investor ownership of single-family rentals, or the Credit Card Competition Act, which goes after Visa and MasterCard, essentially forcing competition in terms of payment networks. Those are, I think, still not odds on, but they could happen. I personally am fairly skeptical that either of those will get done, but it's not inconceivable the same way that the 10% credit card rate cap is.
Tobin, thanks a lot. Appreciate it.
My pleasure.
Coming up, Strategy is continuing to aggressively buy Bitcoin. We'll talk to Phong Le, Strategy CEO and President, next. You're watching Market Catalysts. Strategy continuing its Bitcoin buying spree, acquiring $2.1 billion worth of the cryptocurrency last week. This as the company's shares have fallen by nearly 60% in the last year. Joining me now, Phong Le, Strategy CEO and President. Phong, it's great to talk to you again. Thanks for joining us.
Thanks for having me. Appreciate it.
So why'd you guys keep buying, and why buy in a larger amount than you had been recently, especially as effectively your currency, that is your shares, have been going down?
Yeah, look, 2026 is going to be a big year for Bitcoin. It's going to be a big year for MSTR. And as a result, the best thing you can do as you go into a big year is to start to build a strong capital base. And that's what we've done really over the course of the last few years, but we accelerated the last 2 weeks. The other big thing about 2026 is it's going to be the coming out party for Stretch, which is our preferred equity. We launched it in the middle of last year. It's grown up to be over $3 billion this year. And we think building a strong capital base with Bitcoin, a strong US dollar base, all those things are going to bode well for what's going to happen with Stretch over the course of 2026.
So Stretch and your other preferred share products that are yield producing instruments, they pay out cash dividends. In order to pay out those dividends, Bitcoin price would be more helpful if it was going in an upward direction than in a downward. So how do you sustainably pay those dividends without either selling Bitcoin or continuing to issue new shares?
Yeah, so a few things that we've done, right? We've built up a Bitcoin balance of about $65 billion now. We've built up a US dollar reserve of $2.25 billion. And that allows us to pay the dividends out over the course of the next 60 to 100 years. So we have now duration in terms of stretch. In the short term, what needs to happen is Bitcoin needs to go up about 1.5% a year for us to continue to pay our stretch dividends. So it's not so much a concern about whether we can pay the stretch dividends. The question we have is how quickly can we grow stretch? And here we have, to your point, a product that is backed by Bitcoin, that is short duration money, that is low to very low volatility. Right now, we're at about 7% vol. Over the last couple of weeks, we've seen it go below 5% vol. And it pays 11% tax deferred dividends. So my concern is less paying the dividends and how do we grow stretch over the course of the next year? How do we market? How do we make sure everyone's aware that there's an option out there that gives people, whether you be low income, high income, low net worth, high net worth, you can get 11% on your money. And I think that's a unique feature that everyone is excited about.
Phong, have you guys turned so much towards stretch because people aren't buying your actual equity at this point? I mean, as I mentioned, we've seen the big pullback. You're not trading at a premium to Bitcoin at this point. And there are more options than ever for people to invest in cryptocurrencies.
No, the reason we turned towards stretch is we've been a levered Bitcoin company, right? And so if you think about leverage, what we've done over the course of the last 4 years is we've raised capital primarily through convertible debt. Right? Convertible debt is an illiquid over-the-counter market that has large spreads and isn't perfectly priced. And so we said, instead of something that is an inferior product, let's go to a better form of leverage. We call it amplification. So our equity, MSTR, is primarily there to build a capital base. But really, it's our preferred product, Stretch, which is there to create leverage and amplification on the company. And so that's why we've been focusing on Stretch, not as an alternative to our equity, but as an alternative to debt instruments like convertible bonds, which are inferior.
Phong, I've been talking to you, I've been talking to Michael for a while now, and I have to admit I still have problems sometimes wrapping my head around the business model because setting aside the business software business that you guys have and focusing more on the digital asset treasury, none of this produces any cash flow, right? Either the selling of preferred shares or the convertible debt, you're buying Bitcoin, so I guess I still struggle at times to understand the long-term sustainability.
Yeah, we're a company that's built on the digital transformation of capital, right? If you think of capital and original sort of great store of value capital might be gold, we're a company that's built on digital gold, which is Bitcoin. So I'll start with that. And so when you find a asset that is both a technological revolution and a capital store of value revolution, you buy and hold it, right? Not much different than real estate in the 1900s or oil in the 1900s. Somebody finds an asset that they think is going to, that is truly revolutionary, and they buy and hold it. And so an analogy
but if you're going to use those analogies, in the case of oil, eventually you sell it at a profit, right? And in the case of real estate, it is a yield-producing asset. You rent it out and you get cash flow while you own it. That's not the case with Bitcoin.
Well, what we provide to our shareholders is Bitcoin yield, right? You get more Bitcoin per share of MSTR, right? And so that is the yield. And I know it's a bit of a mental exercise to understand what's the Bitcoin yield versus earnings per share versus yield on your real estate. But I don't think that that's much different. Right. And can we get cash flow by selling the Bitcoin? We can, but that's not in the near term future. Right now it's an accumulation play. And so how our shareholders think about our equity is, are we providing more Bitcoin per share? And we do that by raising capital.
I want to ask you about some of the pending debt obligations as well, because I know because of the structure of the company, you guys, the convertible bondholders, are expecting stock that is worth a certain amount. There is a rather large gap between what the stock is worth now and what they have been promised. So is strategy, once that comes due next year, going to have to come up with that cash to close that gap? And do you have that cash on hand? Do you have to raise that cash in some way? What's the plan?
Yeah, so we have convertible bonds that come due at the end of next year that have a strike price, I believe, in the low 200s. And then we have convertible bonds that come due in 2028 that have a strike price that are north of that. You've seen our stock has been fairly far north of the $200 amount. So the likely thing that'll happen is as Bitcoin appreciates, we'll see our stock rise above that strike price next year and we'll equitize. If that doesn't happen, we have a couple of options. We could refinance the convertible and push forward the maturity at a future point in time, or we can just pay down the debt, right? And we could pay down the debt in one of multiple ways. We could issue equity, we could issue additional preferreds, or we could sell our Bitcoin. So I'm not too worried about the convertible bonds and their maturity that come due in 2027, 2028. These were long duration when we got into them. And Bitcoin price over time goes up. It's gone up 40% a year for the last 5 years. So
well, but there's it's gone 40% up a year, but there's a lot of volatility within that range, right? And so there's no way of knowing when that comes due if we're going to be at 90,000 or we're going to be at 40,000 or we're going to be at 150,000. There's literally no way of knowing, and you have to do sort of balance sheet planning based on an underlying asset that is extraordinarily volatile.
We do, which is why we have the convertibles paced out over time, right? They're laddered out. And if, first of all, I'm not sure that Bitcoin will go to 40,000, but if it does go down, we have a lot of options still, right? Like we have big picture perspective here. We have about $8 billion of convertible with a $65 billion asset base called Bitcoin and $2.25 billion of cash. Right, so this isn't like we're 2 or 3x levered and we have no way to be able to satisfy the debt obligation. We're in fact 10% leveraged. If you look at our convertible debt, or 15%. And so it's not really something that is going to break the company. It's something that, let's say Bitcoin was trading down at $40,000. It's something that will either push out the debt or we'll just pay it down.
And Phong, finally, you started out the conversation by saying this is going to be a big year for the company and for Bitcoin. I'm curious what you see as the next catalyst for Bitcoin prices, right? Because we've not seen them do much of anything so far this year.
Yeah, I think there's 2 major catalysts that I look forward to. I think greater government clarity, right, through our Market Structure Act, which will hopefully pass in the next few months. And there's a lot of discussion, a lot of great work happening at Capitol Hill related to that. And 2, which is linked to it, the traditional banking system, large banks who are sitting on the sidelines, who are working on technical projects, really ramping on either through the issuance of stable coins, the issuance of Bitcoin-backed lending, the issuance of, or the creation of Bitcoin custody and exchange services. I think all of those will really open up. And I think we'll sit here a year from now seeing that not just the US government, but governments around the world and the traditional banking system fully embracing Bitcoin and digital assets.
All right, well, we'll catch up a year from now, and probably before then also, Phong. Thanks a lot, appreciate it.
Thank you, take care.
Coming up, we're sticking with crypto. BitGo is making its stock market debut as the first digital asset company to go public this year. We'll talk to Mike Belshe, BitGo's co-founder and CEO, next on Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tabamo. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Today, we're watching shares of Micron, Datadog, and Capri Holdings. First up, let's take a look at Micron because the chip maker got a vote of confidence from the street. William Blair initiated its coverage on the stock with an outperform rating. Now, the analyst said it believes shares can continue to work on the back of a multi-year AI-driven product cycle as supply remains limited near term. Wall Street's quite bullish on the stock with 45 buys, 4 holds, and 2 sell ratings on the street right now. Next up, Datadog. Stifel upgraded its rating on the stock to buy from hold. The analyst said recent checks lead it to believe the company will post another strong beat on its quarterly results. He also believes that new products and more customers using Gen AI will supplement existing revenue for the cloud-based monitoring platform. The stock is also well liked on the street. It has 43 buys, 4 holds, and 1 sell. Lastly, Capri Holdings, it's the company behind Michael Kors and Jimmy Choo. TD Cowen upgraded the stock to buy, pointing to a sharper price point strategy, the potential for substantial operating margin expansion, and said it's making progress when it comes to the transformation of Michael Kors. The street's kind of mixed on this one. It has 9 buys, 8 holds, and 1 sell. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Crypto firm BitGo set to begin trading on the New York Stock Exchange after raising $212 million in its initial public offering. BitGo is the first digital asset company to go public this year. And joining me now is Mike Belshe, BitGo co-founder and CEO. Thanks for being here, Mike.
Hey, thanks for having me.
So talk to me about the timing of this IPO. You guys first out of the gate this year at a time when crypto prices are not doing a heck of a lot. The record of the companies that went public in your space last year kind of mixed here. So how did you guys think about when you wanted to come public?
Well, look, I think everybody that's in digital asset space is here for the long term. So kind of the ups and downs of where the market is a little bit less relevant to us. We actually started this process, last fall. We thought we were going to kind of get out onto the markets around October, but the government decided to take a little holiday, and so we ended up delayed out until January. But look, I think it's a good time. We've got a lot of business to be done. The fact that we're a public company now is bringing so many more potential clients to us. I mean, really, I think the last year with the regulatory changes, our total addressable market doubled, and then I think with this change, actually our TAM just doubled again.
So the TAM may be higher, but there's also a lot of people in this game, if you will. You guys offer custody, among other services. Coinbase offers custody, Fidelity Digital Assets offers custody, Gemini offers custody. There are a lot of players out there. So what is your pitch to investors about what your competitive moat is in that area?
Well, look, if there's one thing I can dispel right here, it's like, look, we're not a custodian. It's not like we had some grand plan to become just a custodian and that was the end game. No. It's a means to an end. We build infrastructure is what we do, and we build it at the highest compliance and security levels that anyone can ask for. So we're a brand you haven't heard of as much. We're kind of a brand behind the brand, so to speak, and that's because we focused on institutional demands. Now, by the way, we believe everybody on the planet, whether you're retail, whether you're institutional, deserves to have the same level of protection. You deserve to have a fiduciary that's overseeing your money, and we make sure that happens. You get it with your bank, you get it with your stockbroker, if you've got an RIA protecting your investments, all of those guys are fiduciaries. You come to us, you open up your account, you get a fiduciary account. Institutions out there demand this, and so we've always been providing it. We're just continuing to expand that. How we make our money is actually on the services on top, and that includes trading, that includes staking, borrow and lending services, collateral management, and then we also offer this thing called the Go Network, which is a settlement network, which operates not just here in the United States, but across our 7 custodians that we have globally. So we've got a really large footprint, not just here, but also abroad. We connect that all together so that people can do digital assets everywhere.
And Mike, how closely is your revenue tied to the amount of assets on the platform? So in other words, if the price of crypto goes down and the value of the assets goes down, does that mean you're making less?
Yeah, look, I mean, some of our products are certainly correlated to the price of Bitcoin and digital assets. I mean, there's no denying that. But look, it's our job to build a business that hopefully is more resilient than just based on that price. So look, I'd like to have the numbers speak for themselves. Go check what we did in Q3, check Q4. It's all in the S1, you can analyze it yourself. I think in general, coming into the market right now, most people looked at Q4 last year, they said, hey, it was kind of a rough time for the tech sector, even a tougher time for the crypto sector. But I think if you look at BitGo's performance, I think it speaks for itself and it was outperforming.
Well, if you look at the numbers for you guys, the 12 months ended September 2025. I think you guys had $164.7 or so million in net income, but that was lumpy, if you will, right? You saw a drop in the first half of 2025. And I know you guys have been investing to build. You're going to invest in the proceeds from this IPO to build. How exactly are you investing them? And then when do you expect to get to a more sort of sustainable profitability path?
Well, look, I think it's sustainable now, but look, we're a growth company. So look around what's going on with digital assets. Like what we just saw last year, the number of regulated firms that can now touch digital assets that couldn't before. Look at the announcements that are coming out in the market every day, whether it's the New York Stock Exchange's announcement this week, whether you're talking about companies moving to 24/7. All of these guys need digital. And as they move into the digital realm, they've got two options, right? Either they build it completely from scratch, and these are digital assets, right? So they are very different than anything we've ever seen before. Folks need help. So oftentimes they come and they turn around and they partner with us. So look, I know you can get sensitive about the price of Bitcoin being like the total barometer for how our company or our industry works, but as the base grows broader, that changes. Look, we are going to run this company responsibly. One last thing, I mean, BitGo's been around for 12 years, 13 years, and we've raised the least money of kind of anybody in the space. We raised about $200 million total, and we're profitable to this day. So we think the business works. I think also what you see in Q4 is that the EBITDA can start to creep up. So it is a business that will scale. But for right now, we're investing in growth locally and abroad and across multiple product lines.
Mike, something I'm really curious about, you control the majority of the voting power of the shares here, more than half, 55.5%. You own less than 8% of the economic interest. And that's not necessarily, on the face of it, unusual. We see those kinds of patterns in Silicon Valley. It's just more extreme than we usually see in terms of the gap. So you're effectively saying to potential shareholders here, trust me. Why should they trust you? What are you telling them?
Well, look at my history, but look at my pedigree. I think actually it's going to give a more consistent stewardship for the company. Obviously, the board of directors agrees as well. It's not just my decision that went into that. A little bit about me, I'm not actually from Wall Street, even though here I'm at the New York Stock Exchange today. I come from 30 years background in technology. Started my career at Hewlett Packard, was at Netscape before that was a household name, did a number of startups. We are here to build and innovate. We build infrastructure, we're a brand behind the brands. We have to work with the utmost of brands. The fact that they're working with us today means that they've done their diligence, and hopefully that signals the right thing. Obviously my job, still deliver great value to shareholders.
Mike, thanks a lot for joining us. Appreciate it.
Hey, thank you for having me.
Take
Thank
care.
you.
Coming up, a major transition is coming to Walmart. We've got a closer look at what the new CEO needs to do to help the retailer keep its momentum. Walmart is preparing for a leadership transition. John Furner set to take the reins from Doug McMillon effective February 1st. Yahoo Finance's Josh Lipton spoke to Jerry Storch, CEO of Storch Advisors and former CEO at Toys R Us in Hudson's Bay, about what the new CEO needs to do to maintain Walmart's success.
Maybe just start with John Furner. I'm just curious, Jerry, listen, does he have just the right pedigree, resume and experience, Jerry, in your opinion, to lead Walmart forward?
Well, sure. With Walmart, you can't really bring someone in from the outside. So he's been brought up in that culture, he understands the business at a micro level, and so and they've been performing, very, very well, by the way. So it has to be an insider, and he's a star there.
You say in terms of his priorities, let's walk through these, Jerry. What should be John Furner's priorities? Well, one, you say build and motivate the team both at headquarters and the field. Why is that a priority, Jerry? And then walk me through, if I'm an investor, how am I charting his success in meeting that priority?
Well, it's a priority because it's always a priority. And it's a priority for long-term management, but it's especially important when there's a change. Right? Because, culture is so critical to Walmart's success. And so you have to make sure you build a great executive team. He's made a lot of changes in his direct reports, his executive team over what existed under Doug. And so that team has to gel at that level and be seen as working well together and reflecting both the history of Walmart as well as the future. And then all throughout the organization, a key to Walmart is how it works in the store and what the culture is like at that level. So you have to sustain that going forward. It's been, I would say, one of the pillars of the company since Sam Walton started.
Another priority, Jerry, you say, continue to innovate. Now, what do we mean by that exactly, Jerry? I assume, do you mean continuing to leverage AI across the business?
Yeah, absolutely. That's exactly what I mean. This is the most revolutionary change since the internet, and that was probably the most revolutionary change since the steam engine, and that was probably the most revolutionary since the printing press. So they have to embrace AI in everything they do in the business, both customer facing as well as back of the house. Certainly, they understand this. They talk about it all the time, and Furness was recently on a panel with Google talking about this at the National Retail Federation conference. So they get it, but now they have to make it real. It's one of those things where it's a little bit like teenage dating or something. Everybody talks about it, but most people aren't really doing it. That's where AI has been for a long time, and now it's starting to change. It's starting to become not just something you sort of know you have to do, but not sure what you have to do, to something you better be doing and know exactly what you're doing going forward. And so that's why they have to focus on it. It's the future in every business, not just retail.
You also, Jerry, you talked about Walmart perfecting, you say it's all channel business. Now, for those of us who don't follow maybe Walmart and retail as closely, Jerry, what are you referring to there when you talk about the all channel business?
Well, I'm talking about that they both sell in the store, where 80% of retail still occurs, as well as have an excellent internet business or e-commerce business, where the other 20% takes place in the economy as a whole. They have done a wonderful job. They probably have the best developed sort of all-channel model of any retailer, where you can buy online and pick it up in the store. You drive up there and they put it right in your trunk. My wife and I do that for groceries all the time. Or they'll deliver it to your house from the store in your neighborhood, or they'll send it from a distribution center to your home or to other places. So they use all different channels to deliver product to you and leverage the fact that they have bricks and mortar to make it a competitive advantage. And that, frankly, has been something Amazon has been struggling with, trying to figure out, well, they got the internet part right, the sort of the old-fashioned direct mail home delivery model, but the rest of it, the store-based part or the go pick it up part, they've kind of stumbled on. But that's something Walmart's had going for them, and they need to keep leveraging that advantage that they have over Amazon, who's the biggest threat to everyone.
Well, let me ask you about Amazon, because there was this story in the Journal, Jerry, I don't know if you saw this, but how Amazon is opening its largest ever big box store. And I'm curious what you make of that. If I'm a long-term Walmart investor, Jerry, is that a long-term risk on my radar?
I don't know. I think they're at least getting closer to what they need to do with bricks and mortar. It's funny. I've been working with Amazon since when I was at Target. We did the first big deal between Target and Amazon. I did that with Jeff Bezos, where we were linking them together. And it's funny. They never really asked. Maybe they just lift up the phone and call. Like, how should we do? All channel model, because everything they've done has been, in my opinion, incorrect. So they bought Whole Foods to get into grocery. That was ridiculous. Whole Foods is not a general grocer. As you know, it's a very high price, kind of niche player originally, more in the healthy, health food type direction. They should have bought Kroger or Safeway or someone like that if they're really serious about getting the business. And then they keep trying to deliver groceries from everywhere except where they should come from, which is from the store around the corner. And Whole Foods doesn't have a store around the corner for most people in this country because it's too small and doesn't cover the country. So that model, that is the ultimate way to deliver groceries, doesn't work. So, and then they try these small stores, Amazon Fresh or whatever, these little tiny stores. That doesn't work either, because no one likes little tiny stores. They should ask the customer what kind of store they wanted. What customers love is hypermarts. That's what Walmart's doing. That's why they're so successful. So this big store they're talking about building, I think the first one's in Chicago, a suburb or something like that, that's starting to make more sense, where the store's got what you want to buy in it, which is pretty much everything in today's world in a hypermart, and they can use it as a distribution center for that all-important, all-channel model we talked about with Walmart.
Finally, Jerry, I just want to squeeze one last question here, because we're talking Walmart, but Target, now they have a new CEO there too, right? Michael Fidelki. What do you make of him, Jerry? What should his priorities, do you think, be in 2026?
Well, they're in a little different situation, because unlike Walmart, they haven't been doing so well. So what we're all looking for there, and I'm sure the market is change in direction. Walmart's been doing great, so we're looking for innovation. But at Target, they're going to figure out how to win, because right now they have not been winning. And so the big knock on him is not that he's not a smart guy or a good guy or a company insider, but will he create true change? Because change is desperately needed there if Target is ever going to close any of the ground they've lost versus Walmart and versus all other retailers, as their sales have continued to struggle, while Walmart and Costco and TJX and Amazon have thrived.
Jerry, always great to have you on the show. Thank you.
My pleasure.
Coming up, Procter & Gamble's CFO says consumers are being more diligent about their choices. We're going deeper on what that means for the stock next. Procter & Gamble, the maker of consumer staples like laundry detergent, paper towels, and shampoo, reported organic revenue was flat in the second quarter. The company's CFO telling Yahoo Finance he is seeing buyers be a little more thoughtful when it comes to their consumption.
The consumer is choosing to be a little bit more diligent in terms of using up pantry inventory, maybe dosing the product a little bit more carefully, maybe making choices in terms of how frequently they use.
Let's talk more about what this means for consumer staple stocks and P&G specifically. Filippo Falorni is joining us, Citi VP of U.S. Beverages and HPC lead analyst. Filippo, great to see you as always. So overall, when you see a company that you cover saying organic sales were flat, what's your thoughts on that? It does seem like there is this narrative that things are going to improve from here. Is this sort of the bottom?
Yeah, hi, Julie. Thanks. Absolutely. Look, I think this quarter was clearly well telegraphed as being the worst quarter of their fiscal year. As Andrew mentioned in your interview, clearly they're seeing a slowdown in consumer trends, especially in the U.S. The U.S. market was down 2% this quarter, and that's about 50% of the company. But they were also cycling pretty tough comparison in the year ago period. Last year, there was a port strike in October that drove a consumer pantry loss. So consumer really stocked up on their pantry in terms of household essentials. And then there was a fear of a second strike that drove retailers to also rebuild inventories in December. So they had the toughest comparison in the US. The good news for them is if you strip out the US performance, the rest of the world was up about 3% in organic sales. And so their view is that US should get better in the second half of their fiscal year, and the international momentum should continue. So our total company should improve from here.
Let's talk about that international growth a little bit. I think Europe and Latin America were some standout areas. Why are they performing better than the US market?
Yeah, no, absolutely. Look, I think what they're doing in international and what they talked about today on the earnings call is that they started to making more of their strategic changes earlier compared to the US, because in some of these markets, they had some market share issues with local competition, and they addressed them a little bit earlier than the US. And so they focus on innovation, product superiority, and also value to the consumer. And so they're starting to see those results. Within the US, they've been a little bit later to make those changes, and they're implementing them now. So that's what gives them the confidence that the playbook that they implemented in international markets could work also in the US in the second half of the fiscal year.
Filippo, what's the current thinking around tariffs? Not just for P&G, but I'm curious for your coverage area overall, given that it still feels like there's a little bit of volatility there.
Yeah, no, definitely. I mean, Procter & Gamble today reiterated their tariff headwind of $400 million after tax. So that's significant impact on their fiscal 26 guidance. Most other companies have also been pretty consistent in reiterating their tariff impacts. Obviously, some of these companies are trying to mitigate it with a combination of price increases, but selective price increases, because as we mentioned, consumers are feeling the pressure of the large price increases that many companies took from fiscal 21 to fiscal 24. And the other potential offset is productivity. And that's one area that P&G has focused significantly on a lot of other companies in the space, because they don't want to fully pass through the impact of tariff to the consumer, given the environment is not as favorable as it was 3 years ago.
There's a new CEO who just took over at P&G, and so obviously they didn't entirely preside over this quarter. But what are we getting in terms of signals, and what do we hear on the conference call? What degree of confidence do you have?
Yeah, absolutely. Like, this was Shailesh Jejurikar first earnings call. And look, I think he started to talk about like some of this intervention, especially in the US market. So the way they're going to try to improve their market share trajectory and ultimately their top line growth trajectory is a combination of innovation with a focus of superiority, right? Procter & Gamble's success over decades has been developing new innovative product that the consumer view as superior, and it's willing to pay a premium price relative to the competition. So that's what they're going to double down on. And then also to support that innovation-driven strategy, they're going to spend more on marketing, media, as well as some promotions, right? The consumer, as we mentioned, is feeling the pressure, especially at the lower income consumer. We're seeing really a K-shaped consumer environment right now. And so they're going to have to address also the affordability issue with some higher promotional levels. So those are some of the initiatives that Shailesh talked about on the call. And I do think the fact that they worked in international markets gives them confidence that they can replicate the playbook in the US.
P&G is kind of the first out of the gate here of companies in your coverage to report. Anything we can sort of extrapolate to the others? Is this a good signal, or is it kind of its own thing?
Yeah, no, it's a good question. I mean, look, most of our household product and personal care companies are going to report in the next 2 weeks. We do think there's going to be a similar kind of messaging, right? This quarter, the calendar Q4 quarter was still a pretty challenged quarter in the US market especially, but things should start to get better going forward. And a lot of companies are talking about the same kind of drivers, right? Reinvesting in the business, try to drive innovation and better consumer value. The issue is obviously that not all the companies can win at the same time. And so there's going to be a market share fight for sure, especially in the US market. I do think Procter is probably one of the best positioned given their strong track record on innovation and driving superiority in their products. But I also like Colgate, for example, which is also a company that has more international exposure, which is about 75% of sales, that could actually benefit from this improvement in international markets even more than some peers.
Interesting. We'll be watching all those numbers closely. Thanks, Filippo. Appreciate it.
Thanks for having me.
That's it for Market Catalysts. I'm Julie Hyman. Thanks for watching. More Yahoo Finance ahead.